Awesome. Morning, everyone. Dalia put me in charge of waking the audience up, and so I decided to take a detour from the original title and the original slide deck. So we'll see how it goes. It's very much, trying to take a step back and not really provide answers, but potentially maybe raise some of the right questions about the future of money. What do the Silk Roads, the web, and Bitcoin have in common? Now Dalia knows the answer because she probably read a little bit about this. But I was really struggling trying to trace back, when we think about permissionless networks and all the technology that many of you in the room are building every day, what is the history of this? Where does this really take us in terms of where could it go? What are the challenges? And people often refer back to the web, right? So it's like, okay, this is just TCP/IP but for money. But as it turns out, and I'm an economist, there's something that goes way further back in time, which is the Silk Roads, not the Silk Road, the website, which was also an important part of crypto, that has a lot of the same features of what we're building here. It turns out that the Silk Roads were not, a top-down effort. Yes, Emperor Wu of China sent kind of Xi'an to go and explore, but the whole process was very much, organically distributed, decentralized. As people started figuring out that these trade routes were forming, different hubs connected to them. So it was the first truly decentralized network for commerce. Now with spices, goods and services, and also some bad things as usual. And the internet kind of takes it to the next level, moving from the free exchange of goods and services in kind of a market economy to information. The web. We give this all for granted. It turns out that it really unleashed a wave of innovation and creativity. And last is Bitcoin. Kind of the first effort. Of course, there's been a number of different improvements on it. But as you look back in history, you realize that all of these technologies have always struggled with people that wanted to control them. With the Silk Roads, there was a lot of interest in different emperors and kings really tried to dominate different clusters. The technology of the time rebelled and it stayed a lot more distributed. The web, I think the verdict is still out, but the web is a lot more centralized than it used to be. And with crypto, I think the really focus of this talk is we don't know yet, right? And this is kind of what I want to focus on today. What we're witnessing right now, and the battle is kind of brewing, and regulators in DC are getting ready for their part, is that there's competing visions about the future of money. And you should all care, because I think those different visions have different implications for society and the economy. On one side, and I think this is kind of the preaching to the choir, at least to some people in this room, some of us will want an open and decentralized protocol for money. This is kind of the innovation behind Bitcoin and everything that followed. Often people refer back to error code 402, payment required. Everybody's familiar with 404, but to this day, we don't have an alternative for kind of a seamless payment when you're trying to access content, purchase something online. It's really that slide that Dalia was showing of different not really interoperable apps. The web has also led to significant centralization. So again, we shouldn't give for granted a decentralized outcome just because the underlying technology is open and permissionless. If anything, the web has empowered some of the largest, most concentrated players on the planet. And, as it often happens, the empire does strike back. From regulators in Basel to, of course, the banking incumbents, people have taken notice, and I think, we had a little bit of our own fault for that with Libra. We were very loud. And they're all crafting visions for what you should look for in your future wallet. They call it the Finternet, and the best analogy I could find is essentially Apple eWord, or American Online, or Microsoft Network. Now, many of you are in this room are too young to remember. When the internet came about, all these companies had a vision for a curated, safe, keep out all the gambling, porn, all the bad stuff, and present kind of a corporate, cleaned-up version of the internet. Luckily, they didn't prevail, and I think the Finternet is going to kind of follow suit. If you want to zoom out to understand how existential this moment in time for the future of money is, we're already witnessing an infrastructure cold war across many sectors of the economy, right? So think about telecommunication, 5G, then AI, the chip export restrictions, and the same is happening in payments. Because financial infrastructure, many of the things you guys are all building when you're building distributed systems and crypto, raises to the level of future critical infrastructure for how the economy works. And there's a Western block and there's an Eastern block, and you can think of it across, the payment rails, the banking, even the fintech rails and fintech players, all the way to the new crypto ones. It's kind of split on both sides. The stakes could not be any higher. If you're touching payments or money in any shape or form, whether you're a financial institution, you're like a payment service provider, think about Stripe, or digital wallet, or what we in crypto love to call the legacy networks. They're not that legacy just yet. The way this is going to play out is going to affect your business. You're either going to exist or you're going to get wiped out. So for all of you building in this, the giants have taken notice, and they're all kind of planning their own actions. Many of the views of the technology that they have are a lot more centralized than I think people in crypto would want. So I had to go back to, this is going to age me a little bit, but The Empire Strikes Back, which is kind of the part of the Star Wars saga, as this ending where essentially things are kind of like, you don't know if they're good or bad, right? So it's sort of a positive undertone that the good guys will eventually prevail, but the Empire, has a pretty thoughtful position on the matter too. And I think this is exactly where we are right now. Hopeful, but with a cloud of danger. And I'm going to focus on stablecoins, not because they're kind of the topic of the day in crypto. Finally, we found product market fit, and we can kind of scream to the regulators that there is a use case for the technology. But because I think the way the stablecoin wars are going to pan out is going to be a canary in the coal mine for everything else we want to do in crypto. If these wars, end up in a much more centralized outcome, I don't think there's no hope for DeFi and for anything coming after that. Because this is the first battleground, and in a sense, distributed and decentralized technology has to win this. So, the stablecoins are the canary in that little cage. They witnessed massive growth, and a lot of this has surprised most of us. When we were building Libra, I think we had a clear sense of like how much market cap could grow. We have all sorts of scenarios. How do we make this whole thing profitable? And even some of our wildest dreams were kind of not in what we've seen today, at least in terms of market cap. But to be honest, there's only two reasons why we're talking about stablecoins today. One was the Stripe acquisition of Bridge, which suddenly put a kind of a price tag on a startup, and everybody's like, okay, there's exit potential. Everything we're building is going to have a buyer. It was $1 billion acquisition. And the second reason is Tether's profits. If you're a bank today, if you're Goldman Sachs, you're looking at Tether and saying, oh wow, we're going through a lot of effort to make a lot less money, relative to 30, 50 people running this stablecoin offshore. Now, stablecoin is a misnomer, and we have some great speakers that are going to bring a lot more rigor than I will. But I will argue that for the intensive purpose of like thinking about the future of money, what a stablecoin is or isn't doesn't really matter. Now, where it does matter is if I'm a consumer, am I going to be protected? Can I trust this object or not? And we've seen this before, right? So clever computer science, clever market design, blame the economist always, comes up with concoctions that are too obscure for people to understand. We actually wrote a whole paper describing how this will melt down months before it. We shared with regulators, with VCs, with partners. Nobody cared. And then things come crashing down. I mean, tech cannot defy the laws of physics. These objects can be dangerous. And I think part of it is kind of how do we innovate really responsibly in a space that is moving so fast? Especially when, for many, the first use case of the technology is really dollarization. Now, for most of you, this doesn't really matter, right? You have great banking, you have tons of ways to pay for things, your money is safe in your bank, even if there's a run on the bank like Silicon Valley Bank, the government will step in, you're protected by FBC insurance and the like. But there's many parts of the globe where that's not the case. These are people that work hard, save, maybe they're holding Argentinian pesos and poof, the government does something inappropriate, the central bank is not reliable, your savings are lost. And getting the dollar in the hands of those people is an extremely important matter. For them, it's really a lifeline. If you wonder why is Tether so successful, a big driver has been giving access to dollars to people that don't have access to dollars today. Everybody's dream across the globe today is still an account at JP Morgan. Now, Tether is not really an account at JP Morgan, and I'm sure Zay is going to kind of unpack more of that, but it is giving people something that is a better store of value. And it's been working tremendously well. Here we often talk about USDC. There's no comparison, right? So if you look on this graph, in terms of really like the number of active wallets, Tether is like way more dominant, like orders of magnitude. The two top lines are essentially just all Tether usage, and USDC is that little blip at the bottom. And it makes sense, right? So it's minted offshore. It was perceived as out of reach of the US government. And across Latam, Africa, and Asia has become the way to access dollars when you can't. Now, there's good reasons why you may not have access to dollars, and there's bad reasons, right? So you could be a terrorist, a criminal, a sanctioned individual. And unfortunately, we can't really separate those. And when there's new technology, the good and the bad, we'll walk alongside for some time. The other thing people are using these stablecoins for is what is called the stablecoin sandwich. It's a funny name, and I think you would have to adapt the name depending on the corridor, which I'm not going to do. But it works as follows. I need to get money from the US to Mexico. Now, as it happens, both countries are upgrading their payment systems, and these payment systems are becoming more real-time. The US is behind, Mexico has pay. And the way I would do it is I would go from dollar to, say, Tether, and then from Tether to pesos. That's the sandwich, right? So the stablecoin is in the middle. It's like a pipe. It's a very nascent use case. Despite what VCs and others would like you to believe, there's probably not more than $10 to $30 billion of volume every month that's doing this. And again, on this graph, you're seeing that Tether, because it has greater liquidity, is kind of the cheaper of the two vehicles. But this got people excited, right? Because all these domestic systems are being upgraded. Different governments are doing great work, like you have Pix in Brazil, UPI in India. Many of these new networks are really allowing for 24/7 money movement. But when you go across countries, it doesn't really exist. Now again, the BIS is trying to connect all these different central bank digital currencies, and maybe in 20, 30 years we'll get it, but this is live today, and people are using this. So it's an actual use of crypto that is kind of in between the old and the new. It's this phase that has been called the infrastructure inversion. You're running the car on the trail that's meant for horses. You're taking your fancy new modem on top of a phone line that's meant to transmit voice, and you're doing all sort of concoctions to make it work. Are stablecoins better than the old system? Not really, right? And we don't talk about this, but the cost often of a Wise or a large-scale player that has bank accounts in different regions and is essentially doing a database entry when it's moving money are typically lower today. So there's going to be a phase where, if you want the technology to win and not get more concentrated, you will have to implement it in a way where you can play to its advantages. Often speed, programmability, other things that really are kind of still cooking today in terms of the application. And then there's the missing complements. One of the realization of the DM journey was just how much you need to do on top of a simple blockchain to close the last mile. Right, so you have, and Zay's judging me for putting WorkCoin on there, but I'll get to that. Regulators expect payment system to be safe, to be reliable, to have all sort of bells and whistles, and consumers have come to expect that, and businesses too. But without strong identity and something you can rely on, it's very difficult to keep the bad guys out and get the job done. Now, crypto has all sort of interesting experiments. From launching attestations, right? So if you think about the Ethereum attestation service and many others, to the more creepy orb that WorkCoin is trying to deploy. All this to say that I think we have a path to decentralized identity, and again, privacy is going to be a really important component of how it's implemented. But to this room, I would say that decentralization is not guaranteed. Okay? So if you look at the choices people make today, especially around identity, how many of you have used Clear? Go through TSA. Okay, a few of you. Many years ago, people would have thought it dystopian to share your biometrics with a private participant that also got acquired. So you don't know kind of where your data may end up, but the convenience drags us in. Or think about Face ID and all the other technologies that we're using. delivered by Apple, Google, and all of those players. So a big part of the battle for the future of money, ironically, is going to be fought on these complementary technologies, whether it's identity, compliance, all the things you actually need to make money actually flow. People think of money on a blockchain as like, okay, moving, from A to B, but all the workflows around it is really what's hard, and it's kind of the technology that's missing and that we have to build. So how will this play out? I promise questions, not answers. So I'm not gonna tell you kind of which way I think it will go. But I want you to think through which way would you want it to go. And as you're building technology, as you're thinking about the governance around it and everything else, can you play your part to build a better future? Because at the end, I think, despite what the project had a terrible name publicly, I would say some of the people that I love working with were the people that came in for the mission. Are really deploying a system at scale that could connect billions of people to cheaper, faster access to financial services, starting of course with payments. To understand where this will play out, and here I'm going to pretend to be an economist, you follow the money, right? It's a bit like a good crime story. How do stablecoins, how do these assets make money? There's really only three ways, despite a lot of confusion about it. There's the stock of coins, so essentially when you issue a stable coin, right, you're putting money in a bank account or buying treasuries. So that's the big safe, and that safe may give you a yield. This is kind of what makes Circle's S1 not that interesting. Or you can make money on the flow. So when money moves, you take a little tax. That bunch of text is actually a Swift message, and this is how money moves by the trillions today. It's not even a settlement layer, right? So it's just a messaging layer. The actual money moves between all these corresponding banks. It's very clunky. But if you're issuing a stablecoin, you either monetize on the coins, right? So on the stock, or on the coins moving, the flow, which is very tricky because, as you all know, I'm not going to enforce it on a blockchain where people can do all sort of contraptions to disintermediate and do different flows. Or you do cross subsidies. I'm a neobank or a wallet like a fintech. I'm making money from something else, and I'm just going to throw the stablecoin in so that I can capture a bigger part of the market. Those are really the only three ways that stablecoin issuers will be able to make money, and it's going to be quite important for the landscape as it develops. You're already seeing signs that the technology is not trending more decentralized. So for example, some issuers will not charge you for minting coins, but will charge you for redeeming them. It's the oldest trick in the book, right? You build a network that's supposed to be open, and then you slowly make it more closed. And it's quite ironic because, if you look at, this is a graph Chris Dixon put together a few years ago, the whole point of crypto is moving away from these platforms that invite you in. Think about ride sharing or messaging or social media. And then when they have scale, they kind of close the gates and they turn what was supposed to be an open network like the internet into a closed one. And money could go very much the same way. And I think technology has really to be the only counterbalance. So is this going to be a winner-take-all market? Are we going to see like the first global massive fintech that's a stablecoin issuer built on crypto, meant to be open permissionless, and then capturing all this value in a single player? Or maybe two, right? In the card networks, we have Visa and MasterCard, and maybe in stablecoins we'll have Circle and Tether. There's a few reasons to believe that's not going to be the outcome. And the first one is that there are many types of assets that are going to be competing under different legal definitions and legal constructs and protections and constraints, but to consumers, a lot of this will be abstracted away. You're already used to interacting with your financial services with a mobile app. A lot of the complexity of like, oh, am I using a money market fund to pay for this? Or am I using like a deposit in a bank? Or am I using a fully backed reserved stable coin? It's going to be kind of in the background. Now, that may not always be for the best. But ironically is the vision that if you roll back to the first days of X.com, before it merged with PayPal, the whole idea was like, why are we ever holding money in a non-interest bearing checking account, right? Why are we always putting our money to work? I mean, those of you in DeFi, that's the whole point of DeFi, right? So it's like, if there's yield, you're going to put your capital to work. And so you have an ecosystem with like the pure play initial players like Tether and Circle, PayPal, of course, big fintech coming in, Ripple, they have a massive war chest, so they're going to be relevant whether we like it or not. Consortia, that's starting to look a bit like Libra, like the global dollar, by Paxos and friends. Stripe, massive PSP coming in with Bridge and issuing USDB. And then, of course, the asset managers, right? So the banks are not going to sit on the sidelines. If I'm in the money market fund business, I'm going to tokenize it, I'm going to distribute it, I'm going to use all of this technology in combination with fully backed stablecoins to deliver kind of service to customers that would have been very costly to serve before. So this is going to be quite exciting because in a sense that all these different players will fight to death. And for them, for many of these, it's actually existential. Some are coming from the user side, right? So they have users, but they don't have merchants. Some like Stripe have merchants, but they don't have users. So this could play in a number of different ways. And in the end, it really boils down to, are there true network effects to stablecoins? You may have seen this in other technologies that have to do with the internet, right? So if you have network effects, product gets sticky, your ecosystem grows more valuable over time, and eventually you can win. Now, I'm not saying that stablecoins don't have obvious network effects. It could always be that brand recognition, just wonderful execution, right? So if you think about one of the reasons why Tether is valuable, it's not because of their history, it's because they have the deepest network of market makers and liquidity across the globe. Something that Circle hasn't been able to replicate. So that's a form of network effect that matters a lot in crypto, but once the big guys come in, you know, the global asset managers and GSIBs and all the others, things are going to change. So if all of these coins start to look a bit like, you know, one and the same, and regulators are going to play their part in making them alike, are there network effects? And my belief is that they're much weaker than people think. In the end, the strongest feature of a stablecoin, imagine a dollar stablecoin, is that it's anchored to something that everybody understands, a dollar. But that's the actual app. The app is not the stablecoin. The app is the dollar. And that's what we've seen already with dollarization. People want dollars. And they sometimes don't understand that maybe Tether is a very perfect proxy for a dollar at Goldman Sachs or JP Morgan. And if that's the case, then again, there are no strong network effects in stablecoins. And the market will fragment. Many of these players actually want the market to fragment. If I'm a bank, I will want my stable, and maybe my deposit token, and my tokenized money market fund to be the ones that people use and love. If I'm a card network, I definitely don't want one or two stablecoins to displace my card network, so I will want to kind of foster an ecosystem of many of these. And then if I'm a large retailer or a neobank or so on and so forth, I will do the same. Almost there. So why should you be excited? So there's no network effects, so that plays into the more fragmented scenario, which I think is actually good. We're not going to get to centralization too fast. The other reason why you should care about stablecoins is something much deeper, which is they're an unbundling technology. The financial stack tends to be very bundled. In a credit card, you have credit and payment and all sorts of other stuff like chargebacks and fraud. Everything kind of compacted in a package, and you have to buy it. And it's very expensive for merchants. There's all sort of like entrenched players into the whole supply chain. What this technology is doing is breaking that all apart. And when that happens, good stuff comes out on the other side. The last time we've seen it is with the internet, where things that were bundled together got broken apart, and I think we have a lot more choice and competition before of it. But I'll leave you with one last slide, which I still think it's possibly the one that's going to decide the fate of the future of money, which is, well, we can't forget our AI overlords. They're getting ready, and it's very clear that whatever technology AI will use for payments, whether it's through MCP or agent or whatever kind of behavior that's going to be emerging in the future, it's likely going to set where crypto goes to. No answers. That's the last stop. Thank you.
Apologies for the alarm. I realized that I was still wearing a mic and it was amplified. Anyway, thank you, Christian.
Thank you.
And we do have time for questions. I have one, but yeah.
So I have two questions. So you mentioned two cases for stable coins. One is dollarization, the other is maybe some flavor of international payments. I'm wondering what you think of a third case, which would be basically to get rid of credit cards and the 3% tax for interchange fees. and what the potential is for stablecoins there. That's one question. And the second question is, what do you think about the potential for non-dollar stablecoins, like maybe euro or yen or so on? Or is it really all about the dollar?
Those are two great questions. So I'll try to answer them concisely, but we can take it also offline. So on the first one, the card stack is much more complex than just the 3%, right? And if you look at that 3%, most of it actually goes back, in the US at least, to the consumer in forms of rewards. Now, it is true that merchants are paying for the favor of reaching consumers. I'm not even sure that when this is all said and done, some of that won't persist. So there's a reason why merchants want like easy access to consumer paying them, and they're always willing to subsidize some of that. So some form of interchange or cross subsidy may persist even in a blockchain environment. But I think the biggest reason why cards are really difficult to kind of push out of the system today is that distribution really matters. And so I think when crypto will use the technology in the right way to connect, over 1 billion users, which we would have done with Libra, right? So with Libra, we would have had 3 billion users connected, and then merchant aggregators, which in the future might be more like the Shopifys of the world. Everybody will realize they don't need the card networks anymore. And if you look at the script by Stripe right now, that's where they're going, right? Right now, they need to be very friendly to the card networks because they're relying on them. But with USDB, with the PSP, and now with wallets, they have all the ingredients. So I think eventually it's going to happen. And I wouldn't put my money on Visa and MasterCard, but then again, the empire strikes back. So we don't know, right? And then they're making their own moves. On the second, I'm actually a big fan of domestic stablecoins because I think eventually they're going to be needed. The problem is that right now the use case for the dollar is so strong that everybody's kind of blinded by that. Why would you want local stablecoins? Well, most countries, first of all, don't have completely terrible central banks. If you have an unreliable central bank, people will still want always USD stablecoins, but regulators can do a lot to slow down adoption and use of them. But imagine you're taking a loan, right? So now, would you want to borrow in dollars? Absolutely not, right? So all the DeFi, credit, lending, all of that will require domestic stablecoins. And the other reason why I think we're going to see domestic stablecoins is that the system really works at scale, back to that car on the dirt road, when you do have these coins that connect the domestic payment system back to the rest. So that you can go, I don't know, Argentinian peso coin straight through a USD stable coin. That said, liquidity is really low right now because there's no demand. And that goes back to, there's no real use cases. Beyond the sandwich, which to be honest can be done with anything. In fact, you can do the stablecoin sandwich with Bitcoin. That's one of the things we're doing at Lightspark, which is like more liquid, tighter spreads, and you can get payment for order flow because now you're going through a volatile asset. So yeah, I think eventually they'll be important. Right now, they're probably not very profitable. And I think neobanks and fintech in the region, with good relationship with regulators, will be in a great position to issue them.
What do you think about stable coins with bank accounts? Do you think it's possible to have bank account on stable coin?
You mean bank accounts?
Bank account.
Bank
Bank runs. I think after we're going to get legislation, and you should ask Archie about that because it sounds like we're really close. Once a good legislation around stablecoins, I think we know how to design a reserve so that it can withstand a bank run. It's what's typically defined as the fully backed stablecoin. So think of it, the Libra design of 90 days or less US treasuries, plus capital buffers, and all sort of boring banking stuff. That is always bank run proof. The problem with what happened with Silicon Valley Bank was that Circle was holding very large amounts in commercial bank deposits, which they shouldn't have. They were able to wire them all out in time. Also, the Fed stepped in, so everything would have played nicely. But bank deposits, unless you're under the FBC insurance limit, are not really protected.
May I ask a quick, stupid question? So, is there a tension, kind of a trade-off between centrality and so institutions maybe don't care about having multiple stablecoins, or they just use it for themselves and their customers. But the fungibility. So for me as a user, if I want to use my stablecoin and pay somebody who uses a different stablecoin, is there a trade-off?
I think if the regulators do their job, they should be fungible.
Well, they're doing it around the clock
Yeah.
as we're having this
Right.
event. So Zaid keeps, just so you know, she keeps running out to get calls from the Senate to close this bill for us. She will talk to us at the end of the day. It's done? Okay. Okay. All right.
I think that they need to be boring enough that consumers shouldn't care. And that's where you're not gonna use USD A, B, C, D, X. You're just gonna use programmable dollars, self-driving dollars, whatever you wanna call them. People will just see a dollar balance and they should be comfortable enough the same way when they see a dollar balance in an app like, PayPal, Venmo, or there's always, clauses and footnotes on that, but yeah, for most intensive purposes, we'll see adoption when that is done.
Yeah, I guess going back to the question of alternative stablecoins, I feel like I can see stablecoins as like a special case of tokenization of any type of asset, right? So if one of the main use cases of stablecoins is dollarization, surely if we can tokenize some dollar-denominated asset with a yield, I don't know, treasuries or even like mortgage-backed securities or something, would that not see flows into that and sort of away from stablecoins, like kind of eat away at the market there?
Absolutely, and look, the dollarization use case is a bit of an anomaly right now, and we'll see how it plays out, and many countries will not want that, right? The same way many countries limit the open internet. There will be ways to make it extremely difficult for you to hold a stablecoin. Now with crypto it's a little bit harder, but like if you can start, cracking down on use at the point of sale, or like, knocking down people's doors and checking if, they've been using stablecoins. There's a lot that governments can do to limit that flow, and different assets will compete. So some people will use tokenized treasuries, and others will use tokenized money market fund. I think it will really vary by use case. That's why the market is also not as profitable as people think. Right now it was an anomaly, right? So there was no other option in crypto but to either trust Tether or Circle. And yeah, that's not the end state, and sometimes people look at that as, oh, this is a very profitable business, but as things mature, I think they might be very different.
All right. Christian will be here the rest of the day. Thank you.